Good morning, everyone. Good morning. So today we are going to start our session on fair value measurement, which is Ind AS 113. So from examination perspective, you can put it in the medium category importance. It has come a couple of times in your exam. It has shown its presence in RTPs. So it is a medium category standard. You can get what you can say questions ranging from close to 5 to 8 to 10 marks at the most. Okay. But from a practical perspective, this is one of the most important standards. Why? Because you are all aware that you have been studying Ind AS since the past couple of weeks or months. And in all these weeks or months of study of Ind AS, you would have seen that fair value measurement. You would have seen that fair value, that term is being used very commonly. Whether you talk about property, plant and equipment, whether you talk about investment property, whether you talk about impairment, in all these cases, you would be having your fair value coming out as a discussion. Now, the issue is why this standard had to come in force. Am I not audible? Hello, can anyone please confirm? Namrata is saying my voice is not clear. Hello. Hello. Is my voice clear? Others, please confirm. Shailesh, Viraj, Yadu. Okay, yes. So I think just check your net connection at your end. There may be some small disturbance. Okay, all right. So now, why do we have a separate standard called fair value measurement? Did we have a corresponding ICAI standard? Can anybody tell me, did we have a corresponding Indian GAAP standard called fair value measurement? Answer is no. This did not exist. Now, why did we not have a fair value standard under the Indian GAAP? And why did we require a fair value measurement under the Ind AS regime? So, Ind AS 113, obviously the parent standard of this is IFRS 13. Okay. So, we have drawn it from here. Why do I have a separate standard here and why did I not have it there? In the Indian GAAP, the fair value was at a very nascent stage. The fair value was at a nascent stage. The fair value was at a preliminary stage. So wherever you had references to fair valuations, the definition of fair value was most probably given in that specific standard itself. For example, you had revaluation of assets. It's not a new thing under your Ind AS 16. It was there earlier under AS 10 also. Okay. So the extent to which fair value was used was not far-fetched or as prevalent as it is under Ind AS under the IGAP regime. And that is why we did not have a corresponding standard under the Indian GAAP. But when we talk about Ind AS 113 or the Ind AS regime to be more specific, we are having fair value measurements across the length and breadth of the standards. You could look at fair value measurement. You could look at fair value measurement in Ind AS 16 when you did the revaluation model. You could look at it under Ind AS 40, investment property. You could look at it under Ind AS 109, that is your financial instruments. You could look at it under Ind AS 105, non-current assets held for sale. You could also look at it under Ind AS 19, where you require plan assets to be fair valued. So basically, you name the standard and you have a fair value measurement that is required, an accounting that should happen at fair value. Now, the standard setters had two options. First option, see, every standard requires fair value. Now, if fair value is not defined in that standard, then the readers of the standards, the standard the entities who are applying these accounting standards, the auditors who would audit the financial statements based on Ind AS, all these people would not have an understanding of what is fair value. So they would have to insert fair value in each and every standard that you are seeing, in each and every standard that you are seeing. Now that would become a very cumbersome exercise, and it would unnecessarily increase the length, breadth, the size of my standards. So what the standard setters thought is, we will put a special standard, IFRS 13, which talks only about fair value measurement. And we will also mention that wherever we want the readers of the standards, the entities applying the standards, the auditors understanding the standards, wherever we want these people, we will, to understand what is fair value, we will mention in each of these standards that fair value refers to the fair value as defined under IFRS 13, or in our case, Ind AS 113. So wherever you have this particular word that is coming up, Ind AS 109, for example, 105, for example, 19, for example, wherever you see the connotation fair value, they will mention fair value refers to the fair value defined under Ind AS 113. And that concludes the topic. So you, me, everybody knows that we have to therefore refer to Ind AS 113, that is fair value measurement. Okay. So this is a very important standard from your practical applicability purposes. Okay. So fair value will be applicable to only assets, not necessarily. It can be applicable to liabilities also. It can be applicable to your equity also. It can be applicable to your equity as well. So all the three components we are going to study. The key topic or the key importance which I am going to give is to the assets. Two reasons. One, it is easy to understand. You will be able to get a lot of your concepts clear on understanding the applicability to assets. And secondly, once you know the applicability to assets, you can only extrapolate it to liabilities and equity, and you will be able to understand the principles there. Okay, so these are the broad, this is a broad introduction to Ind AS 113. Now, when I come to the standard per se, what do you expect by Ind AS 113? Can anybody tell me what are your expectations of Ind AS 113? Do you believe that the moment we take this Ind AS 113 and apply this, the standard will give out the fair value of Ind AS 113? Is that what you think? Answer is no. It's not something like, Acha, I have to do fair valuation of property, plant and equipment. Okay. So I have to apply Ind AS 113. Okay. So I will apply the principles, and what topples out of this is fair value of PPE. If you think that this is what is going to happen, then unfortunately, you are highly mistaken. This is not the intent of Ind AS 113. Ind AS 113 will not give you the rules. Ind AS 113 will not give you the computed value. Ind AS 113 is not going to give you, Achha, this is the value of input, so this will be the fair value of it. That is not what Ind AS 113 gives. Ind AS 113 instead gives you the principles of fair value measurement. It gives you the principles of fair value measurement. Achha, what do you mean by principles? Principles means it tells you how you can compute the fair value. It does not compute by itself. It tells you the manner in which the fair value should be computed. It gives you guidance. For example, it gives you a hierarchy. We'll come later, but just as a brief thing for you to know, it will tell that first of all, you look at whether any quoted values exist for your asset or liability. And thereafter, it also moves and talks about what you can say, principles of fair value measurement. It tells you how can I compute the fair value. It does not give a computed value. It tells you how to do it. So a fair value is not some value that is floating in the air and you just pick it and apply it to your fair valuation. Fair value is what you and I should understand to be a computed value. It is a computed value. अच्छा, तो computed value का मतलब क्या होता है? Sir, we have to compute. Okay, so if I have to compute, does Ind AS 113 give me the formula? Does Ind AS 113 give me the formula for fair value computation? Answer is no. It gives the principles. It gives the principles. For example, just for example, okay, let me just explain to you. For example, if I have an investment in equity shares of Reliance, if I have investment in equity shares of Reliance, now I have to do a fair valuation of that because Ind AS 109 requires investments in equity to be fair value. Now, how am I going to do it? Sir, I can do it by looking at the market value. Yes, by looking at the market value. The second way is I will look at the comparable valuations of companies operating in the same sector. So what I'm going to do is I will look at the comparables. I will look at the comparables. And when I look at the comparables, I will get a particular value and then I will do some adjustments for my company. So comparables with adjustments. Third one is, sir, na to comparables hai, na market price hai. So what I could do is, I could go ahead with a valuation based on Gordon's formula. I could go with a valuation based on Gordon's formula. Okay. Now, all these three fair valuations are possible. The question is, does Ind AS 113 prescribe to use Gordon's formula? Answer is no. Does it say you have to use the PE multiple? Answer is no. None of these are mentioned. So if I have to talk about fair valuation of a non-financial asset, for example, a plot of land. If I have to talk about fair valuation for a plot of land, do you think Ind AS 113 will tell, no, you have to look at the value in the surroundings? Do you think Ind AS 113 prescribes that? Do you think 113 tells, no, if I have to do the valuation of a non-financial asset in the nature of property, then I have to call a registered valuer to do that. Is it mandatory? Answer is no. Ind AS 113 does not give any of these prescriptions to us. But Ind AS 113 tells, if you have to compute fair value, how am I going to do it? How am I going to achieve it? That is what Ind AS 113 is going to discuss about in its entirety. Okay. So, Ind AS 113 does not give any formula. Ind AS 113 does not give any value. Ind AS 113 is not a rule. Ind AS 113 is a set of principles. It is a set of guidelines. It is a set of principles which entities are expected to follow to arrive at the fair value. Is fair value a value that is just dangling in the air? Answer is no. It is a value that you and I have to sit and compute. It is not so easy the way we are discussing. In practical life, it's complicated. But you have to follow the principles of fair value measurement. You have to follow the principles of fair value measurement. Is it okay till now? Are you able to understand? Yes? Anybody has any doubts? Yes? Namrata, Yukta, Shailesh, Geeta, Vanshika. Did you guys follow Viraj, Yadu? All clear so far? Yes? Shall we proceed? Okay, fine. So now, what are we going to discuss under Ind AS 113? We will be discussing the need. I've already covered that. What is the coverage of Ind AS 113? What exactly do I mean by fair value? and then certain key aspects relating fair value. And then we move on to valuation of non-financial assets, then valuation techniques, applying fair valuation rules to liabilities and equity, offsetting fair value at initial recognition. With this, we are going to conclude the standard. Okay. Now, need for Ind AS 113. We have discussed this, but we'll just look at it from a different perspective. See, normally assets and liabilities are exchanged between parties at their agreed terms and conditions. Okay. So when you enter into a transaction with anybody, it will be based on agreed terms and conditions, and they may not be at arm's length prices. Okay. So, for example, you could be buying at reduced prices. You could take a loan at lower interest rates. You could take a longer credit period as compared to other market participants. Okay. Yes. Okay. Ind AS 113 does not prescribe the method, but the way to use the methods. Ind AS 113 tells you what methods are available. Ind AS 113 tells you what methods are available. You will have to use your judgment and see what best you can apply. So Ind AS 113 will not tell you you have to use this method, but Ind AS 113 will tell, look, these are the methods. Number one, it would be better if you follow this particular hierarchy. Ind AS 113 goes to that extent also. But after that, Ind AS 113 will never tell you. For example, we have three-step hierarchy. Level 1 inputs quoted market prices. Level 2 comparables with certain adjustments. Level 3 is your what you can say own computations. Okay, we'll come to that later. But level 3 means there is no input available in the market, and therefore you have to use your own judgment, your own inputs to arrive at the fair value. So Ind AS 113 tells, okay, so give the first preference to level 1 input, then to level 2, and last to level 3. But Ind AS 113 will never tell you that if you do level 3 inputs, it is incorrect. Ind AS 113 will not tell that. That is something which you have to use your judgment to determine. You have to be crystal clear that level 1 market inputs are not available for fair value measurement. Level 2, I don't have comparables, and that is why I'm applying level 3. These items, this manner in which you arrive at the method should be clearly documented when you prepare your financial statements. Okay. So the valuation of assets or liabilities or equity should be from the perspective of a market participant. Should be from the perspective of a market participant. We'll discuss more on this later. Okay. So now, why is this important? I have again discussed this. So the ICAI model was primarily the cost model of accounting, but under the Ind AS regime, we have fair valuation embedded in almost each and every standard. And therefore, there is a shift in my accounting perspective. And because there is a shift in my accounting perspective, it becomes important for me to understand what fair value is. So if this standard was not there, if fair value was not defined anywhere, then what would happen? You would not be able to present a true and fair view. Suppose A Limited has shares in Reliance and he takes the market value of 2,500. B Limited also has shares in Reliance, but B Limited will say, I'll not take the market value. I will compute the valuation. I will compute the value, do the valuation, prepare a model, look at the cash flows, discount it to present value, and then I will determine the value of Reliance Industries Limited shares which I am holding. Nothing wrong, but the issue is, am I giving a true and fair view of financial statements? That is something B Limited will have to answer. Relevance and faithful representation and verifiability ends up getting violated. Okay, and because these fundamental characteristics, if you remember the framework, which unfortunately I had only taught you, then the fundamental characteristics end up getting violated. And in the enhancing characteristics, your verifiability also ends up getting compromised. And therefore, we would not be in conformity with the what you can say with the framework. And that is why Ind AS 113 ensures that we comply with the framework. We comply with the framework. Okay. Now, what does Ind AS 113 do? What is its objective and what is the scope? What is the scope? Okay. Now, when I talk about objective, the objective is to define fair value, which we are going to see in 5 to 7 minutes from now. To define fair value, number one, to set out in a single Ind AS the framework for measuring the fair value. And third one is disclosures. So it prescribes three things. First one is what is fair value? Fair value kya hai? So that is the first question it answers. Second thing is all the principles of fair value measurement. It puts it everything together in one single standard. So it gives a single standard for framework for measuring the fair value. And the last category is disclosures. The last category is disclosures pertaining to fair value measurement. Now, when I look at the scope, where it's applicable, where it is not applicable, then it is applicable where Ind AS requires fair value measurement, permits fair value measurement. Okay. And for example, it would tell Ind AS 109 that you will have to look at Ind AS 113 for fair valuations mentioned in Ind AS 109. The how to do the fair valuation is not mentioned in 109. You will then come to 113 and determine how are you going to arrive at the fair value. So in this case, the measurement as well as disclosure, both of them are applicable to Ind AS. Both of them will be applicable. Both of them will be applicable. Non-applicability is classified under two types. Measurement also not applicable, disclosure also not applicable. So what are those? Well, they could be your standard on share-based payments. Ind AS 102. The fair valuation principles are given there, the disclosure principles are given there, and therefore you will not look at the same in Ind AS 113. Same goes for leases under Ind AS 116, and same goes for items where it appears to be fair value, but it actually isn't. For example, the net realizable value in Ind AS 2 or value in use in Ind AS 36. Have you studied Ind AS 36, my friends? Have you studied Ind AS 36? Yes. If you have studied Ind AS 36, are you aware what do you mean by value in use? Yes. Have you studied Ind AS 36? Yes. So in Ind AS 36, tell me one thing. Do you know the concept of value in use? Do you know the concept of value in use? Yes. This comes when we talk about recoverable amount. When we talk about recoverable amount. What is recoverable amount? Well, it is higher of fair value less cost to sell or value in use. Are you able to recollect this? Yes. Are you guys able to recollect it? Yes. And when I talk about Value in use, yes, as all of you have rightly said, Yukta, Namrata, Mohammed, Tanisha, value in use is present value of future cash inflows. Present value of future cash inflows. Now, my question to you is, and answer after thinking. Present value of future cash inflows. Is this specific to the entity owning the asset, or is it any cash inflow to any XYZ person who can own the asset? Yes, I'm asking you one step further. You know that it is present value of future cash inflows. My question to you is, are these cash inflow estimates specific to the entity owning the asset, or is it a general version? A general version of cash inflows. What do you guys think? Is it specific? I got two answers, one from Yukta, one from Namrata. I'm waiting for the others. When I talk about value in use and the present value of future cash inflows is what you are saying. The estimation of future cash inflows from that asset. Is it my estimate as the owner of the asset, or any third party can also say this is the asset, these are the cash flows, do the fair valuation, do the present valuation, and you get the value. Is it a specific cash inflow estimate? Answer is yes. It is specific to the entity. It is specific to the entity. It's not a third party value in use computation. It is a computation that is specific to the entity owning the asset. And therefore, the value in use concept does not fit in Ind AS 113. Does not fit in Ind AS 113. Why? Because Ind AS 113 is specifically a market-based standard. Is specifically a market-based standard. It encourages, it does not require, but it encourages, it makes sure that you follow those fair valuation principles based on the fair valuation in the terms of the market, in market context, not in terms of the entity's context. And therefore, value in use, when we talk about, though it is present value of future cash inflows, number one. Number two, Ind AS 113 permits to do a fair valuation based on present value of future cash inflows. That is also allowed under Ind AS 113. But the cash flow projections which you are giving is specifically restricted, limited to the entity owning the asset whose value in use you are computing. And therefore, that is excluded from the purview of Ind AS 113. Right? So therefore, they are similar to fair value measurement. They are similar to fair value, but I will not call it fair value. So one of that is value in use. One of it is value in use. I'll come to NRV later because you will understand this best when we do the types of markets, etc., etc. That time I will revisit this NRV. Disclosure, that means here measurement is applicable. Measurement principles apply. Measurement principles apply. So therefore, what does it mean? What is excluded? Disclosure of plan assets at fair value. How to compute? You will have Ind AS 113. What to disclose? That Ind AS 19 only will be telling for the plan assets. Assets for which recoverable amount is fair value less cost of disposal. Fair value less cost of disposal. Okay. So therefore, this particular thing, Ind AS 113 is applicable, but only to the extent of determining, measuring, arriving at the value, computing the fair value. It's only restricted to that. Disclosure related to that is not covered under Ind AS 113, is not covered under 113. It will be covered under Ind AS 36. Okay. So this is exactly the scope of your Ind AS 113. Are we clear with this? Are we clear with this so far? Yes. I will come to that, Namrata. I will come to the future cash inflows is based on what. Okay. Is it clear, everyone? Yes. No. Okay. Fine. So now you can go through this example for homework. It's a very simple example. It's picked up from your study material. Okay. Now let us come to what is fair value. बहुत हो गया introduction. Half an hour I have spoken. The moot point of our discussions today and tomorrow is what do you understand by fair value? I hope you have downloaded this. It's uploaded on the portal. Yes. So now coming to what is fair value. And this is one of the most beautiful definitions that you will come across in Ind AS. Okay. You have some very interesting definitions across Ind AS. One of that is fair value definition. The fair value is defined as the price. Okay, which price? The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants at the measurement date. And for the better part of today's session, we will be focusing only on this. We will be focusing only on this. So when I talk about fair value measurement, I talk about 5 legs or 5 limbs or 5 pillars to this definition. The first pillar is it is a price. Which price? It is a price that would be received to sell an asset or paid to transfer a liability. Are we clear? So suppose I have A Limited and another entity B Limited. So A Limited, let us assume, owns an asset, a plot of land. So if I have to do the plot of land valuation, it will be the price that A Limited will receive. The price that A Limited will receive on sale of asset. On sale of asset. Right? So it is the price that would be received. It's not necessary that you make the sale. It's not necessary that you make the sale. What is necessary is that it is the price that would be received. Means it is your estimate कि ये मेरा asset है, मुझे इतना amount मिलेगा अगर मैंने बेचा तो. If I sell, I expect that this is the amount I will get. Are we clear with the first part? The price that the entity expects to receive on sale of asset, number one. This is the first part of the definition only. I'm still in the first part. It is also the price that the entity expects to pay to transfer a liability. It is the price that an entity expects to pay to transfer a liability. For example, again we take the same case, A Limited, B Limited. A Limited has debentures worth 1 lakh rupees. Has debentures worth 1 lakh rupees. Now, the debentures worth 1 lakh rupees are there. B Limited wants some funds. B Limited wants some funds urgently. Yes. It cannot go to the bank and do all the formalities at this point of time. B Limited knows that A has some debentures. So what B Limited will do is, you have issued debentures and collected 1 lakh rupees. Very good. What you do is, you just transfer those debentures to me. So A Limited will say, Areba, so you want my debentures. Very good. Take it. That is what A Limited will say. B Limited will say, no, 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 I cannot just take the debenture value from you. You have to pay me the money also. Why will I take your liability on my head? It has to become my liability. And for it to become my liability, you, that is A Limited, has to pay towards transferring this liability. So A Limited will say, fine. So based on the current fair valuation measurement understanding, I determine that the fair value of this is 95,000. I determine that the fair value of this is 95,000. So therefore, what will happen is A Limited will transfer the debentures of 1 lakh and gives a cash of 95,000. So now B Limited is having cash of 95,000, debentures of 1 lakh, and these debentures of 1 lakh is going to be redeemed on maturity by B Limited and not by A Limited. Are we clear with this? Yes. So it is the price that the entity expects to receive on sale of asset or expects to pay on the transfer of the liability. Are we clear with this? Yes. So therefore, whether I talk about an asset or whether I talk about a liability, whether I talk about an asset or a liability, when I say price, it means an exit price. It specifically means it is an exit price. Exit price का क्या मतलब है? Exit price means it is a price that you are going to arrive at based on the partaking, or what do I call, the transfer or selling or sending out the asset or the liability. So when I talk about price, it is specifically an exit price. It is specifically an exit price. Okay. It is specifically an exit price. Now, सर एग्जिट प्राइस तो ठीक है, बट आप मुझे बताओ, यू टेल मी व्हाट विल बी द वैल्यूएशन, हाउ विल आई डिटरमाइन व्हाट इज द एग्जिट प्राइस. फॉर एग्जाम्पल वी कम, a person comes from outside India, arrives at the airport, and after he or she arrives at the airport, they go to the what you can say, they go to the authorized exchange where they can exchange their currency and get INR. So now they go there and then they do the exchange. Now in the exchange, we are having two rates. One is the bid rate and the other is the ask rate. One is the bid rate and the other is the ask rate. The question is, how am I going to do the valuation of the dollars which I am holding? How am I going to do the valuation of the dollars which I am holding? Right? So therefore, the question is, how are you going to do it? Come on, tell me. Yes. I have the following rates. $1 is equal to rupees 83, rupees 85. You remember this, right? If I buy the dollar, if I sell the dollar. So the entity has dollars. So if it has to sell the dollar, it will get how much? If I have to buy the dollar, how much will I have to pay? What do you guys think? Have you done financial management? And in that you have this particular concept, right? Bid rate, ask rate. Yes. Which rate are you going to use? 83 or 85? You can check any currency rate. ये दो चीजें हमेशा रहेंगे. They will be different. They will be different. Okay. So now tell me which rate. Suppose you are having $100. Okay, you are an entity. You are having $100, and now it is the year end, and you have to do it at the closing value. What valuation are you going to give? Will you value $100 at 83 or will you value it at 85? What are you going to do? What are you going to do? Buying 85, selling 83, you are already owning $100. It is in the currency of the company. So you are owning that. And because you are owning that, you tell me at what value will you convert $100 to INR? You have to report in your financial statements. You cannot say I have $100 in cash. Your financials are prepared in INR. So my question is, which rate are you going to use? 83 or 85? Think and answer. सोच समझ के जवाब देना. Simple question. Okay. Will you value it at 83? Will you value it at 85? Somebody has said we'll take average of both. 85. Good. I'm getting different answers. Geeta. Prajwal has given one answer. Geo Paul has given one answer. Okay. Now, you are having 100. The value of this dollar for you is to be done based on an exit price. Exit price. Exit price means what? The price which I expect to receive on sale of an asset. Is this $100 currency my asset? Answer is yes. So if $100 currency is an asset, I have to convert it to INR because my financials are prepared in INR. And because my financials are prepared in INR, what am I going to do? I will have to determine that on the sale of these $100, I expect to receive 83, not 85. You expect to receive 83. 85 तो उसका buying rate है. See, 85 तो that is his buying rate. When you go to the currency dealer and give this, he will not give you 85 rupees. He will give you 83 rupees. Achha, you sell 83. Immediately बोलोगे no, I made a mistake. You give this currency back to me. Do you think he will sell it to you at 83? No, he will sell it to you at 85. तो बोलोगे एक मिनट पहले तो आपने खरीदा था सर, वो मेरा प्रॉफिट मार्जिन है. 83 and 85 के बीच जो गैप है, that is known as spread. The spread is the profit which the currency dealer makes on buying and selling of currency. He will buy it from you at 83. That means it is his entry price, but for me, it is my exit price. It is the amount I expect to receive if I have to sell this asset of $100. And because I expect to sell this asset at $100, at 83 rupees, 83 becomes my exit price, and the basis for performing my valuations and reporting will be at the rate of 83 rupees per dollar. For $100, it will come to 8,300 rupees. But can I take 85? Answer is no. वो आपको मिलेगा ही नहीं sir. You are not going to get that rate. समझो बात को. You are going to pay that amount if you have to buy the dollars. But for the existing dollars that you have, you are going to get only 83. and nothing else. And nothing else. Are we clear with this? Yes. So this is to be specific, a, a an exit price. To be specific, this is an exit price. So all those who said 85 or average, okay, I think I have two, three people who said average. Yes, all of you who said 85. Are we clear why it cannot be 85? Yes, Vanshika, confirm. Tanisha, are you clear? Yadu, Manoj, Viraj, Gio, Paul, Akshara, are you guys clear? Mohammed, did you understand? Yes. Geeta, did you follow? Yes. All right. So that takes care of the first part only. That takes care of the first part only. That is, we have discussed price. It is an exit price. Okay. That would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. Between market participants. Okay. So now let us move on. Let us move ahead. Suppose you have a plot of land. You have a plot of land. Now, this plot of land is owned by A Limited. Is owned by A Limited. A Limited has expertise in constructing residential properties. It has thousands of projects in this sector which pertain to what you can say, which pertain to construction of residential properties only. A Limited does not have the exposure, expertise, understanding of construction for the commercial complex. Okay. So A Limited does only residential complex. Okay. And if it is only residential complex, the value of the land, the value of the land is going to be rupees 1 lakh per is going to be rupees 1 lakh per square meter, is going to be rupees 1 lakh per square meter. But on your property only, you could also construct commercial premises. सर वो तो मुझे आता ही नहीं है. अरे आपको नहीं आता है, but can you construct commercial complex on that? Answer is yes. If you can construct commercial complex to on that plot of land, you are going to transfer it for 1,50,000. You are expecting the rates to jump to 1,50,000. Remember, A Limited is only specialized in residential properties. But on his plot of land, you can also build you can also build commercial complexes. And if you can also build commercial complex, the valuation of that will tend to 1,50,000 per square meter. Will tend to 1,50,000 per square meter. Now the whole issue is how will A Limited value the land? Will it take as 1 lakh rupees and close the matter, or will it take 1,50,000 rupees and close the matter? What do you guys think? Think and answer. Okay? Think and answer. A minute. Yes. So I'm getting some answers. I got only two answers. Come on, guys. This is just not done. You have to tell me because only then I will understand how much you have understood. Okay? Tell me. I got only two answers. Yes. Now Geeta also put in the answer. Namrata, Tanish are very active. What about the others? Yedu, Akshara, Geopal, Mohammed. What do you think? A Limited's point of view, if this is the plot of land, the definition is it is an exit price 1 lakh per square meter because A Limited does only residential projects, but on that plot of land, commercial projects are also possible, but A Limited is not specialized in that. Okay, so the question is, so my question is, there is this plot of land, okay, owned by A Limited. A Limited does only residential projects. It is a specialist in that. For residential projects, the rate is 1 lakh per square meter. That will be the value of this plot of land. Whatever square meters, 100,000, 10,000, jitna bhi hai. But on the same plot of land, you can also do commercial complexes. And if you do commercial complex, the value is actually going to be 1,50,000 per square meter. A Limited owns this land and it wants to determine the exit price of this. It wants to determine the exit price or take it as the fair value. We have studied that fair value is the price that the entity expects to receive on sale of an asset in a transaction between market participants. I want you to tell me what will be that value. Will it be 1 lakh or will it be 1,50,000? This was the question I had asked. I got a number of people who are saying 1 lakh. Very good. I got equal number of people who are saying 1.5 lakh, even better. Anybody else? Yes. Okay. So Shruti gave the answer. What about Mohammed? Mohammed has not answered. What about Manoj? Manoj has not answered. What about Shailesh? What about Yukta? What about Viraj? What about Namrata gave the definition, yes, and the answer as well. Yadu, what about you? You also have not answered. Yes, come on, tell me. Okay, so Manoj has given the answer. Vanshika has given the answer. Yadu has given the answer. Yes. Okay. Now, let me slightly modify the question so that those of you who gave a particular number will think from a different perspective. Let us suppose it is not A Limited, but it is you who is owning this land. It is you who is owning this land. So let us assume that Yedu or Geopal or Vanshika or Tanisha, you are the people owning this land. You have to do the fair valuation of this. It is the value that you expect to receive. You are doing only residential property, but on the plot of land that you own, commercial construction can also happen. Now you tell me, if somebody comes to buy it from you, will you sell it for 1 lakh or will you sell it for 1,50,000? Give me an honest answer. Give me an honest answer. Yes, I'm coming to that, Tanisha. You're absolutely right. Okay. What do you think? Are you going to sell it at 1 lakh or are you going to sell it at 1,50,000? Yeah, बेचोगे नहीं. But my question is, what is your expectation? Do you expect to collect 1 lakh or do you expect to collect 1 lakh 50? Think from the perspective of the owner of the land, not from the perspective of, uh, what you can do. Yes, think and answer now. You are the owner of the land. कितना expect करोगे आप? Will you expect 1 lakh or will you expect 1 lakh 50,000? Yes. Geo call. Yes. Absolutely right. You cannot expect 1 lakh. It's not fair for you to expect 1 lakh because your limitation of constructing only residential properties is an entity specific limitation. Understand that. It is an entity specific limitation. A Limited is not an expert in constructing commercial complexes. It is an expert in residential complex. It has made its name in residential complexes, and therefore, A Limited being unable to build commercial complex is an entity specific restriction. Is an entity specific restriction. But A Limited will tell to anybody who comes, look, this is a land where commercial complex construction is permitted. I do not know what you are going to do. And honestly, I don't care what you are going to do. You may build residential, you may build commercial, the choice is yours. But on this premise, commercial construction may be possible. And therefore, I will expect 1,50,000 per square meter. That is my final price. That's it. You will not say 1 lakh. You will not go one step further and say that, sir, we will think what the seller will, a seller can say how, we will think what the buyer will construct and then quote the price. Why? The buyer's restriction is again an entity specific restriction. Suppose A Limited to buy this land, it contacts B Limited. B Limited भी वैसा ही है, only residential complex. Is this an entity specific restriction? Answer is yes. You can go to any X, Y, Z and they will all say we will build a commercial complex on this. And therefore, anything can happen on this plot of land. So A Limited will expect to collect not 1 lakh but 1,50,000 rupees. But 1,50,000 rupees. This is an expectation, my friends. This is not actual sale. This is not actual sale. It is the price that the entity expects to receive on transfer of land, transfer of an asset. So A Limited's expectations at the back of its mind is, this is the land worth 1,50,000. So tomorrow, if A Limited has to follow the revaluation model, if A Limited has to follow the revaluation model, which requires fair valuation, then it has to take 1,50,000 rupees as the fair value. Then it has to take 1,50,000 as the fair value. Sir, A Limited तो बनाएगा नहीं the commercial complex. So what? You are valuing an asset. You have to consider asset specific characteristics and not entity specific characteristics. Are you clear with this? Yes. Are you clear with this? Right? Any doubts? Any doubts? Anybody? Anybody has any doubts so far? Geeta has confirmed. Namrata, are you clear? Prajwal, Manoj, Vanshika, Viraj, Mohammed, are you guys clear? Geo, Paul, Manan, Yadu, is it fine? And then Tanshika, Vanshika, Tanisha, Vanshika, Shailesh, are you guys clear? Yes. Are you guys clear? Yes. Now, let us slightly modify this as I always do. Okay. Let us slightly modify this. A Limited is now doing both residential and commercial. सोच के जवाब देना, think and answer, don't jump to the answer. Okay. A Limited carries out both residential as well as commercial constructions. It is an expert in both. It is an expert in both. Now, let us come to our plot of land. The plot of land has permissions only for residential complex construction, where the expected rate is 1 lakh per square meter. So currently the asset is suited only for residential complex. Only for residential complex. Now, anybody who buys this plot of land can apply for permission to the government, to construct a commercial complex, maybe a mall. Okay. So, this particular plot of land can be converted to commercial, construction subject to government approval. As on date, when I'm owning the land, only residential is permitted. But in future, it can be converted, it can be developed into a commercial premises based on approval from the government. And when that happens, the value will appreciate to 1,50,000 per square meter. Today, only residential construction is allowed. A Limited does both residential, commercial, residential, everything. Now I want you to tell me, what will A Limited expect on the sale of this land? Will it expect 1 lakh or will it expect 1,50,000? Think and answer. Okay. Think and answer. Okay. So on comparing the dollar example with the current example, does it mean if we want to sell? I will come back to you, Shruti. You have slightly misunderstood the dollar example. Okay, I'll come back to you. Yes. Yukta, I will come back to you on that also. Okay, all right. I want to see answers because I want to know your level of understanding. Then there are a couple of things where we still have skeletons of the past in our brains, right? So I want to ensure that those skeletons are erased from your memories. Okay? Right. So I'm getting some answers, but I want all of you to answer. Shruti, answer this. Geeta has given the answer. Yadu has given the answer. Shailesh has given. Tanisha has given. Namrata has given. What about the others? What about Vanshika? What about Viraj? What about Mohammed? What about Manoj? Akshara? Yes. What about you guys? Tell me. Prajwal, I'm waiting for your answer. What do you think now in case 2? As on date, there is no approval. I made it very clear. It is only for residential complex. 1,60,000 है ही नहीं. It is 1 lakh or 1,50,000. Please don't manufacture values. Already we are sitting miles apart. Okay? Yes. Okay. Okay. Good. Understand now. Understand now? Let us be very clear. Can A Limited do commercial as well as residential? Yes. So is there any entity specific restriction? Answer is no. But the asset what you are holding, currently it is permitted only for residential complex. Yes. But sir, हम permission भी तो ले सकते हैं ना? We can take permission in the future. Sir, if you are taking permission in the future, are you not modifying the characteristic of this asset? Arey bhai, on this plot of land, right now, the permission is only for residential complex. If you are getting a permission for commercial complex, you are changing the very nature of the asset. Yes or no? Are you not changing the nature of this asset? Sir, I am changing the nature of this asset. Let us assume B Limited comes to A Limited to buy this land. B Limited wants to do a commercial complex construction and A Limited knows that. Do you think A Limited will say, look, you will do commercial complex, I will sell it to you for 1,50,000. B Limited will say, I don't want your land. Because if I have to pay you 1,50,000, it's not going to work from me. Currently, your property is worth 1,00,000. I have to run to the government office, make applications, pay the conversion fees, and then this land will be converted from residential to commercial. As on date, it is not a commercial premises. You cannot expect me to pay you for commercial premises because आज के दिन तो वो है ही नहीं. It's not commercial premises today. I have to take the land, do the change, and then make the commercial complex. So as on today, is this suitable for commercial complex? No. There is a restriction. And what is the nature of restriction? It is an asset specific restriction. It is an asset specific restriction. So therefore, the asset specific restriction, can I ignore that? Can I ignore that? Answer is no. Answer is no. I cannot ignore it. Okay. I cannot ignore it because it is forming part of that asset. It is a feature of that asset. When you transfer the asset, along with the asset, you are transferring that restriction also. You are transferring that restriction also. And therefore, your premise will be fair value at 1,00,000 per square meter. Will be fair value at 1,00,000 per square meter. Are we clear with this? Yes. Any doubts so far? Anybody has any doubts? Yes. Got it? So entity specific restrictions, ignore. I wrote wrong color. Entity specific should have been in red because it is to be ignored. Asset specific restrictions you will have to consider at the time of fair valuation. At the time of fair valuation. Good. Now I have a couple of queries. First query. Sir, if I do the valuation from 1,00,000 to 1,50,000, won't it be against the law of prudence that we are overstating the value of an asset? See, let me make one thing clear. Revaluation is optional. Revaluation is not mandatory. Number one. Number two, if you are following Ind AS 105, where you are disposing of the asset, you will have to disclose it at the book value or fair value less cost to sell, whichever is lower. Okay. So there also you have prudence. Okay. Standards will prescribe. I'm not saying you have to follow revaluation model. No, choices of the entity. But if you choose revaluation and your value is higher, why are you worried about prudence? What have just tell me one thing very honestly, and this is a discussion I have had. This is the seventh batch that is going on, and students always come up with the defense on prudence. That is because we are so much ingrained with prudence, conservatism, prudence. What have we achieved with prudence? क्या मिला हमको? I am, see, actually, asset value is 1,50,000. You are stating it at 1 lakh. Are you giving a true and fair view of your asset? Are you giving a true and fair view of your asset? Let me take it one step further. Suppose you are owning equity shares of an entity. Okay, you are owning equity shares, let us say of Zoom prior to the pandemic. Okay, the pandemic came, Zoom shares shot up through the roof. Okay, you had bought it at $10 per share, for example. Today it is worth $1,000 per share. Ind AS 109 does not give you an option. It tells you have to do fair valuation for equity. You have to do fair valuation for equity instruments. There is absolutely no ambiguity in that. So, sir, 10 to 1,000, that means 990 rupees appreciation I have to record. Yes, you have to. Sir, वो तो prudence के against है. कौन सा prudence? Why are you worried about prudence? The Zoom company in which you have invested has proved to create massive value at the time of pandemic. Now people can do their meetings, do their calls, do this class through Zoom meetings where the value that the company has sought to create has now been unlocked. And that value has gone reflected in the price of the share. And therefore, appreciating the value of the share is acceptable because that is what is the value, the true value, the fair value of this. Number one. Number two, is prudence an essential characteristic in terms of the conceptual framework? Let us look at that. I'll just open it in a short while. Okay. Just give me a couple of seconds. This is your conceptual framework. Look at the fundamental characteristics. It is relevance, it is faithful representation, and when I look at the enhancing features, it is comparability, verifiability, timeliness, understandability. In the characteristics, do we see prudence? Do we see prudence? Answer is no. We do not see prudence. Prudence is a thing of the past. I'm not saying you go overboard and do all kinds of manipulations in your numbers. No. But when the share of Zoom has gone from 10 to 1,000 and Ind AS 109 requires a fair valuation, please do the valuation at 1,000 and take this 990 gain to P&L or other comprehensive income depending on the policy choice you follow. And because you are following this, you cannot say that your financial statements are not following prudence. They are doing a faithful representation. Is it complete? Yes. Am I neutral? Yes, I've taken a market value of 1,000. 1,50,000 also in our example was the market value. 1 lakh also was the market value. So neutrality, and it is free from error. 10 to 1,000, 990 rupees I will increase, $990 per share. It is a simple arithmetical calculation. It is free from any errors. So I have achieved a faithful representation in my numbers. Prudence cannot be the guiding principle henceforth. Okay. What would happen with prudence is we would overstate our losses, we would overstate our liabilities, we would understate our assets. This has grossly happened across all sectors. The Ind AS regime, the IFRS regime tells us why to be so prudent. What have we achieved? If you are going to disclose numbers in your financial statements, be realistic about it. Let us be realistic about it. I discussed with you revenue from contracts with customers. If you remember, the variable consideration component was discussed in that. In the variable consideration, there was a component known as bonus if you had to complete the project within a specified time gap. The Indian GAAP regime said that you cannot recognize the bonus until the project is actually completed, and when it is completed, you book it on receipt basis because of prudence. I will not book my revenue until I collect the amount. I will not book my bonus until I'm sure of getting it. Ind AS tells us, why do you want to get into all that? You are doing the job. You know how much time you can complete it. So in just basis those two things, come to the bonus, add it as part of your consideration and project it as an accumulation over the tenure of the project. Go ahead and do it. There is nothing wrong in that. There is absolutely nothing that is incorrect in that. Are we clear with this? Yes, prudence is not a guiding principle. Do not look at it going forward. Okay. So, in other words, you are going to focus on asset specific restrictions and not on entity specific restrictions. Okay, so this is one thing that you will have to factor in. This is one thing that you will have to factor in. The next one is, I had another question comparing the dollar with the current example. See, let me make things simple. Okay. A Limited has land one side. This is A Limited. Just change the presentation. A Limited has two assets. Okay. A Limited has $100 and A Limited has land. A Limited has $100 and A Limited has land also. Now, the rate here is rupees 83.85. Okay. The rate here is 83.85. The rate here is 1 lakh for residential, 1,50,000 for commercial. We have to do the valuation of these assets. Now, if A Limited is in the business of only commercial, but the land can be of any type, residential, commercial, both, then if A Limited has to do a fair valuation, it will obviously take 1,50,000. It will obviously take 1,50,000. Absolutely no confusion on this. But if there is a restriction on the land for commercial complex construction, then it is an asset specific restriction. You will do the valuation at 1 lakh rupees only. So this is our explanation for the land, and I hope it's clear. Coming to the dollar, A Limited has $100. Now, A Limited will sell this dollar to whom? It needs rupees. So it cannot go to the market, open a stall and say that $100 for sale, please give me 85 rupees. A Limited cannot do that. You need RBI permissions to become a currency dealer. So you go to the authorized currency exchange platforms. The currency exchange platforms will not offer you 85 rupees. The currency exchange platform will offer you 83 rupees for the dollars that you have. So for you, the dollars will fetch only 83 rupees. 85 को खरीदने का rate है. 85 is the rate for buying the dollar. 83 is the rate for you to sell the dollar. In other words, if I talk from the currency dealer's perspective, the currency dealer will sell the dollar at 85 and buy it at 83. The spread of 2 rupees per dollar is the profit that the currency dealer is going to make. So today, you as the holder of $100, you cannot say that I will sell it at 85 because I am not a currency dealer. I am not a currency dealer. I am a regular entity who has foreign currency. Yes. And because I have the foreign currency, I have to do the valuation. So my rate is what the market is going to give me. And that rate is 83, not 85. I'm not a currency dealer. If I was a currency dealer, then perhaps I could take it as 85 because I could be assured of a sale rate of 85 rupees per dollar. But I am not. And therefore, I will do the fair valuation at 83 and not 85. Are we clear, Shruti? Yes. So everybody looks to be quite clear about this. Yes. Yes. Anybody has any doubts on the first part of the definition? Anybody has any doubts on the first part of the definition? That is the price. Yes, it is clear. So, when I talk about fair value, it is a price. Sir, which price? It is the price that you expect to receive on sale of an asset or expect to pay to transfer a liability. So, these are your expectations. Okay, these 2 points. The next one is what you can say. Yeah, so this was what was the discussion. Yes, all right. So first part is done. That is, it is the price. So which price? Price that the entity expects to receive to sell an asset or pay to transfer a liability. So this is the first part. You will consider asset specific feature, asset specific restrictions. Don't take it only restriction. Suppose this land is situated in a very pristine location. That is a very enhancing aspect of that plot of land. Okay. And therefore, its value increases. Let me just modify this example for you. Suppose I have constructed a shop, I have constructed a mall. Okay. I have done a mall construction and I am in the process of allotting the shop spaces. I am in the process of allotting the retail spaces. All of you must have been to malls or seen some things. Okay. You tell me, ICAI Limited has constructed a mall. Okay. And in the mall, okay, I'm just giving you examples of asset specific features. Okay. I'm just giving you example of asset specific features which could be considered in fair valuation. So A Limited has constructed a mall and this mall has a number of retail spaces. Now, how are the retail spaces? One, they could be road facing, ground floor, direct entrance. Matlab, you do not have to get into the mall, you can directly enter the store itself. Second, interior shops, no entrance. Second category. Third category, you could have shops, malls, etc. with AC ducting in the premises. Okay, you have some entity, some retail spaces where AC ducts come into your shops. The mall's AC ducts goes in different places, so those ductings come into your shops. The other shops, what we saw above, do not have ductings, but they just have the outlets. Okay. So these are the categories. Then you have shops on higher floors, road facing, but unfortunately, for obvious reasons, कोई उड़ के तो नहीं जा सकता, no direct entrance. Okay. So you tell me, as somebody who is expected to have business sense, yes, you tell me a road facing shop on the ground floor with a direct entrance. Is this a positive feature or is this a negative feature or is this indifferent? कोई फर्क नहीं पड़ता सर हमको. What do you think? A road facing shop is an advantageous position. Interior shops, no road facing, no entrance directly. Okay. Do you think it is a positive feature or a negative feature? AC ducting in the shop, is it positive or negative? Shops on higher floor, is it positive or negative? What do you guys think? Obviously, road facing ground floor shops, retail spaces with direct entrance is a positive feature, a big positive feature. Why? Customers can just look at your board and walk into your shop. They don't have to do anything. They just look at your board, they want to buy something, they just come inside. And therefore, the pricing of these shops will be higher compared to those which are in the interiors. So that is why you have a number of food outlets in some of the malls which come on the outer side. That is McDonald's or KFCs or Pizza Huts. They normally are on the lower floor because customers just walk into the shop, take their food and then come outside. Okay, so you are having this manner of feature. You are having this manner of positive features. Okay, you will, for obvious reasons, for example, you will not have a tile shop, tiles for the flooring. You will not have tiles on the ground floor because who will buy tiles as a walk-in? Those who want to buy tiles will absolutely be sure of it. So they will not mind searching for the tile shop in the mall rather than placing it in the road facing side and ensuring that you get visibility. You can give visibility in some board or in some signpost. Those who want to buy tiles will search the shop and buy the tiles. They will not put it on the outside because it is not an FMCG item. It is an item of permanence, an item that has a huge cost. So customers buying it know that they want the tiles, they will look for it no matter wherever it is. So you will not have a tile shop on the front facade of the mall. You could have fast food joints. You could rarely have some clothing joints like whatever you have, this Aditya Birla Group's pantaloons, this, that, everything. Okay. Anything could be there. But my point is, all these features, road facing, no direct entrance, higher floor, all these are asset specific advantages or disadvantages. Both of them will be considered when you are doing your fair valuation. इसमें entity specific कुछ भी नहीं है. It is just asset specific. And therefore, will I factor them when I do the fair valuation? Answer is yes. You will factor it when you are doing the fair valuation. Are we clear with this? Yes. Are we clear? Anybody has any doubts? So far, this is what we have discussed. You discussed value in use, my friend. Value in use was fair value of cash inflows. Sir, which cash inflows? Sir, my cash inflow, asset specific cash inflow. We are talking about fair valuation. Fair valuation is a market participant's perspective. Value in use is asset specific perspective. Both are 180 degrees facing each other. If value in use is from entity perspective, fair value बोलता है entity specific कुछ नहीं. We look at the market specific perspective. We look at the market specific perspective. Both of them are diametrically opposite to each other. They are not same or similar even in the most remote sense. Are we clear with this? Yes. So that concludes our first point. That concludes our first point. Okay. So we have discussed on the price. We have discussed on the price. Okay. So I have summarized it in the presentation. You can check it when it is uploaded. Fair value is market specific and not entity specific. I have told this to you. I have told this to you. Okay. Fair value measurement takes into account the characteristics of the asset or liability. I explained to you. Land already having permission for residential as well as commercial. Do I take that into account? Answer is yes. Sir, land with a restriction on commercial, do I take that into account? Absolutely yes. And therefore, the features of the asset or liability have to be considered. Example, the condition and location of the asset, the restrictions, if any, on its sale or use, etc., shall be taken into account. Okay, shall be taken into account. However, the restrictions or conditions related to a particular entity should not be taken into account. A Limited is only specialized in residential construction. Do I have to consider it for fair valuation? Answer is no. Why should I have to consider that? I am not going to think anything about that. I am going to focus only on asset specific features. Because a fair value will be based on market participant assumptions rather to an entity specific conditions or restrictions. Are we clear with this? An entity shall measure the fair value of an asset or liability using the assumptions that the market participants would use when pricing the asset or liability. So what is the rule? Entity specific restrictions or conditions are ignored. Asset or liability specific restriction or conditions which will be ultimately transferred to the buyer, we will have to consider that. We will have to consider that. Are we clear with this in all respects? Yes. This is our summary. I'll leave these questions to you for homework. Okay. I leave these questions to you for homework. Okay. All right. We now move to the next aspect, that is unit of account. Okay. This is not very important. You just have to read this for the sake of reading because it's there in the standard, but it is a very simple explanation. Okay. So what do I mean by unit of account? Unit of account means, okay, let me explain to you with an example. A Limited has land. In this case, the unit of account is that single plot of land. The unit of account is that single plot of land. Okay. So unit of account could be a standalone asset or a liability. Suppose A Limited wants to transfer its debentures to somebody who is in need of funds. So those debentures alone will go. So in that case, you have to do the fair valuation of that debentures. And therefore, they become a standalone liability. What do you mean by standalone asset or standalone liability? It means you will do the fair valuation only of the land by itself. You will not add any asset, any liability to that land. You will do it as a standalone asset, as a standalone liability. So we call that as one of the units of account. Unit of account is like You remember in your earlier days, you would have units of measurement: centimeters, millimeters, kilometers, miles, okay, kilograms. All these are your unit of measurements. This is something like that. That means I am measuring the value of one plot of land. I am measuring the fair value of one debenture. So this is what becomes your unit of account. Acha. Sir, is it always going to be one by one? Is it always going to be one asset, one liability? Not necessary. Not at all necessary. Sometimes a group of assets and liabilities, sometimes a group of assets or liabilities could also be considered as a unit of account. For example, suppose you are entering into a slump sale where you are transferring an entire division, or you have built your company in such a way that you have identified cash generating units. I hope you are able to recollect what do you mean by cash generating units. Okay. This was there in Ind AS 36, cash generating units. It is a group of assets that give cash inflows largely independent from other assets, if you recollect this. So suppose I just extend that cash generating units and bring it to Ind AS 113 and also say that suppose I have this asset. I'm a real estate developer. I also have my own what you can say, I'm a real estate developer and I also have my hotel business that is there. So the hotel business is an independent entity by itself. Okay. It is independent in procurement, in staffing. It is independent in carrying out the activities. Okay. And it is independent in generating revenue also. So the hotel business, its assets, liabilities, net worth, that is funds from HO, all these things put together would give me what? It would give me the fair value of that hotel division, So therefore, in that case, you are going to, in that case, you are going to do the valuation on a combined basis. You will not value hotel building one, spoons one, cutlery one, ऐसे करके नहीं करोगे. You will do a complete evaluation of the what you can say of the division. You will do a complete fair valuation of the division. Are we clear with this? Yes. Are we clear with this? Anybody has any doubts, any issues? Okay, so this is not very important. It is just for you to understand that unit of account could be standalone or unit of account could be a group of assets. Who decides that? Not Ind AS 113. Ind AS 113 बोलता है how to measure fair value. Do I have to measure fair value on standalone basis, on merged basis with assets liabilities together? Ind AS 113 बोलेगा why should I tell that यार? वो तो मेरा काम ही नहीं है. That is something which is the decision that needs to be taken by other standards, not Ind AS 113. Okay, so other standards will tell whether this is a single, what you can say, other standards will say whether this is to be valued on a single standalone basis or whether it is to be merged with other assets and liabilities for a more consolidated value. Okay, so this is unit of account. So I'll be leaving you with homework for these. These are all examples. You can go through them. So I had done example 2 for you. You can take that. Example 2, 3, example 5 and 6. Example 5 and 6. Okay. So that takes care of unit of account. And then we come to the next part, that is market participants. Market participants. We'll take a 10-minute break. Today I'll be leaving you guys a little early by 9:30, 9:35. Tomorrow we'll have a long session. Okay. Tomorrow we have to complete this and Sunday we have to complete the other standard. So we'll take a 10-minute break and after the break we shall continue with this topic. Okay, today I should be able to finish market participants definition and then appropriate market letters. Okay, so we take a break right now and assemble after 10 minutes. 8:50. All right, guys, welcome back. So, let us proceed. So, we have seen so far that we look at asset-specific restrictions, ignore entity-specific restrictions or advantages. We have also seen what do we mean by the price. It is an exit price, basically received on selling an asset or paid to transfer a liability. So that is how your fair value measurement will actually start. So now we come to the other legs of the definition. We now come to the other legs of the definition, which is equally important, Okay. The next one is market participants. It is a price that would be received on sale of an asset or paid to transfer a liability in a transaction between market participants. Okay. So why this particular aspect was put in the definition? Why did they have to highlight this? That is because they want us to tell that it should be like an arm's length price. That is the pricing from the perspective of a market participant, an outsider, an unrelated party. Okay. That is the price that would be received, paid, settled, etc. on transfer of an asset or liability by or to a market player. So you have to estimate the price, you have to estimate the value depending on how much it would be for a market player and not for a related person like your holding or subsidiary or associate or joint venture, whatever it is. Okay. So who are the market participants? These are the parties which eventually transact the assets or liabilities. For the time being, you just ignore these words. Okay. For the time being, just ignore these words. These are the parties who transact on the assets and liabilities in the market in their best economic interest, not the selling entity's economic interest. It is in their best economic interest. Okay. So, what does it mean is these people are knowledgeable people as far as the transaction is concerned. They know what is their interest. They know what is the proper value they can afford to give for a particular asset or receive for a particular liability. They know that. And that is why we are always discussing it from the perspective of a market participant. Now, what are the key features of market participants? They should be independent. That means not a related party. They should not be a related party. Related party by default, always keep this in your mind. जितना भी arm's length हो, whether it is arm's length, foot's length, body length, कौन सा भी length पकड़ लो, your related party transactions are shrouded with suspicion. They are viewed with huge amount of risk, huge amount of suspicion, whether it is the income tax, whether it is the GST, whether it is the Companies Act. Everywhere related parties come with a lot of red flags. So when I talk about fair value, the company seeks to tell us that it should be based on the transactions with independent persons, not related parties. However, they have put a caveat saying that if related parties have done similar transaction on arm's length price, then it can be between related parties as well. In the rare scenario that you are entering into transactions with related parties, then it could be at arm's length basis also. Because you have certain businesses where it is unavoidable. For instance, you have a demerged entity. Okay, you have a parent entity, and then it demerged one of its business to another entity. Now the resulting entity is getting orders from customers, but the existing orders were always there from the earlier entities, and therefore those orders will be routed through the parent company, the resulting company, so on and so forth. And that is why it is going to create a lot of related party transactions. And that is why they have probably kept this particular caveat saying that related parties are not unavoidable, but if at all they have to be considered, they should at least be at arm's length price. They should at least be at arm's length price. The next one is parties should not be under any stress or force to enter into these transactions. And finally, they should have reasonable and sufficient information about the assets, liabilities. All the knowledge should be there, which is required to understand before buying or buying an asset or getting a liability. Okay, so all this data, all this information is available to market participants. In other words, they are well-informed independent party with whom we are going to transact, and fair value is based on the transactional value with these market participants, Okay. So now I'll be leaving this example for homework. The most of it is what we have already covered. So I don't have much to discuss on this. These are examples just for you to understand. It's not illustration or a question. Okay. It's not an illustration. They're just saying it's a further explanation to the standard provisions that we have shared. Okay. So just go through this examples. You will be in a position to understand. Coming back to our discussion. Sir, transaction to hoga with the market participants, but kahan pe? Sir, market participants will obviously be visible in only the market. So therefore, the standard says it is the price that the entity expects to receive or pay to transfer an asset or a liability in a transaction between the market participants in the most appropriate market. In the most appropriate market. You can see the definition of fair value. It is the price for transaction between market participants. We have discussed this in the most appropriate market. Okay, so this is what we are now going to discuss. This is what we are now going to discuss in detail. Okay, all right. So what do we mean by appropriate market? And for this appropriate market, we are having two basic markets that is identified by Ind AS 113. The appropriate market could be of two types. One is known as the principal market and the other is known as the most advantageous market. One is principal, the other is the most advantageous market. It is there in the presentation that I have shared with you. Principal market and most advantageous market. Okay, all what I'm speaking is there in this slide, so just listen to me. Okay, now the standard gives us guidance. The standard gives us guidance on which market should be accorded priority. The standard says if we have the principal market, then we will take the value of that asset or liability in the principal market to be my fair value. Okay. Suppose the principal market does not exist, we will move on to check what is the most advantageous market and take the pricing based on the price in the most advantageous market. So priority comes to the principal market. And if principal market does not exist, we go further to the most advantageous market. Okay. Now, sir, वो सब तो ठीक है. Priority भी समझ में आ गया. But explain to karo what is my principal market and what is my most advantageous market. Okay. By without explaining that, how can we know what is principal market, what is most advantageous market? So let us understand the principal market. Principal market. This is a market having highest number of buyers. highest number of buyers, highest number of sellers, highest number of transactions as compared to any other market in question, as compared to any other market in question. ओके, तो इसको हम लोग बोलते हैं प्रिंसिपल मार्केट. You remember in economics also we had studied a scenario of perfect competition. We had studied the scenario of perfect competition where perfect competition is that form of market where you have maximum number of buyers, sellers and transactions compared to any other market in question, and there are so many buyers and sellers that a single buyer or a group of buyers or sellers cannot influence the market price. इसको हम लोग बोलते थे perfect competition. So in similar terms, we have the principal market definition where you have the maximum number of buyers, sellers, transactions, etc. And therefore, a person or a group of individuals or a cartel cannot influence the market price, cannot influence the market price. The market price will always and always tend to the fair value of the product, will always tend to the fair value of the product. Are we clear with this? Yes. So the principal market has what we have discussed is highest number of sellers, highest number of buyers, highest number of transactions as compared to any other transaction. As compared to any other transaction. Are we clear with this? Yes. Are we clear? Any other doubts? Yes. So my first preference when I have to look at the fair value, it is the price expected to receive on sale of an asset or transfer on or paid on transfer of a liability in a transaction between the market participants in the most appropriate market, that is the principal market. So the price in the principal market is what you and I will be looking at. So for example, let us suppose you have shares of Reliance. You are owning shares of Reliance. Acha. Reliance Industries is traded on BSE as well as NSE. Are we aware of this? Yes. Acha. So now the question is the console. Do I have to take BSE? Do I have to take NSE? Okay, so it starts with that. Now, till the NSE was launched, till the NSE was established, you always had transactions only in the Bombay Stock Exchange. You had transactions only in the Bombay Stock Exchange. However, with the advent of the National Stock Exchange, the transactions in the NSE have multiplied more than the BSE, and therefore your principal market could probably end up being the National Stock Exchange. Are we clear with this? Yes. Anybody has any doubts? No doubts. So this will be my principal market. Okay. The question is, sir, how to find out principal market? Well, the entity would obviously know what is the principal market for its products or services. Yes. So therefore, they can take that as the basis for your determination of the principal market. Is it clear? Yes. All right. So now, suppose you are having what you can say, you are generally having knowledge of your principal market. Okay, you're generally having knowledge of the principal market because you also try to sell the goods in the principal market. You also try to sell the goods in the principal market, because there you are sure you are going to get the fair value of the product that you are supplying. You are getting the fair value of the product that you are supplying. However, in some cases, or in many cases actually, principal market may not be easiest to find, may not be easy to find. You could end up with no principal market or multiple principal markets. ओके अभी हम कहां ढूंढते फिरेंगे प्रिंसिपल मार्केट कौन सा है. So automatically the question arises is, sir, in that case, how do I understand what is my principal market? It's not there. So the standard has given a second option. If principal market does not exist, then you move on to the most advantageous market. You then move on to the most advantageous market. Remember, you will come to the most advantageous market only when you are convinced that there is no principal market for the commodity. There is no principal market for the commodity. And therefore, when I talk about most advantageous market, this is which market? This is the market which either maximizes the net proceeds when an entity sells an asset or minimizes the amount that is to be paid while transferring the liability. So this is the market that an entity expects to sell because it maximizes the net proceeds. Let us discuss this with the help of an example. Okay. Okay, I'm just seeing whether any question I could take from the form. Take a fresh one. So, what is the most advantageous market? Most advantageous market is where highest price is available. And when I say highest price is available, I mean net proceeds. So how do we factor this? Let us assume that we are dealing with mangoes, for example. Okay. So the local quality mangoes have a price of rupees 1,000. Whereas export has a price of rupees 1,500. Export goods have a price of rupees 1,500. Okay. Now, if I look only at these prices, you tell me which is the most advantageous market. Yes. Yes. Export. Clearly, export ends up being the most advantageous market because the selling price is more in export. But look at the definition. It is maximization of net proceeds, not of the selling price. So therefore, from the price, you will be subtracting transportation cost. If I have to sell my goods, I have to ensure they move to the marketplace. Yes or no? I'm coming to net proceeds. I'm coming to net proceeds. If I have to move my goods, I will incur transportation cost. Yes. They will not come to India and ship the goods, right? They are going to get they are going to get our goods to that marketplace. Yes, it will fetch in movement of our goods from our place to the marketplace. Now the question is, suppose the transportation cost is 100 and suppose it is 700. So therefore, what is going to be the remaining price? So this will be 800. Are we clear with this? Yes. Sir, we are going to incur the transportation cost because goods have to be moved from this location to the other location. So therefore, there is no doubt that you will not that about incurring the transportation cost. वो तो आपको करना ही है because you are moving the goods. Are we okay with this? Yes. So what is remaining is 900 and 800. What is remaining is 900 and 800. Are we clear with this? Yes. Are we clear? So now, who is going to be the most advantageous? If I looked at this stage, yes, local is higher or export is higher? See, you will not look at this price anymore. That was the price you saw the first time I asked. Now you will not look at this because for every 1000 rupees sale, for every 1500 rupees sale, you are paying 700 rupees as freight cost. You are paying 700 as freight cost. And therefore, you will be left with 2800. Are we clear? Yes. Sorry, 1500 minus 700 will be left with rupees 800. So clearly, see, you are selling the goods, but to sell the goods, you have to move your goods. Understand the definition of fair value. Fair value considers asset specific characteristics. It considers asset specific nature. It considers asset specific features. It considers asset specific characteristics. And therefore, the movement of goods from one location to another and then third, this movement of goods is ultimately going to be met out of your what you can say. This ultimately movement of your goods ultimately gets factored in your net proceeds calculation. Are we clear with this? Yes. So at this stage, I would prefer local because that is the one which maximizes my profit. Okay, that is one which maximizes my profit. So that takes care of this. The next one is, let us further complicate this. Okay. Yeah. So now you are also having certain transaction costs. Apart from transportation, you are having certain transaction costs. Right? Now, what do we mean by transaction cost? Transaction cost is brokerage, commission, any sales related expenditure, okay, selling expenses, administrative, etc. All of that put together form part of your travel cost, form part of the travel costs. Okay, I'll share the examples. Okay, now when I talk about transaction cost and I subtract it, so let me give a transaction cost of 400 and here let me give a transaction cost of 150. This is rupees 500 and this is rupees done. Okay, yeah. So this is fine. So now we are going to incur certain transaction costs. Transaction cost means any cost that you are entering not related to the asset but related to the transaction. For example, brokerage, commission, sales expenses, specific. Okay, that's it. So these are our transaction costs. These are our transaction costs. Acha. After deducting the transaction cost, what we are left with is your net proceeds. I will explain what is transportation cost separately. Transaction cost is very clear. So what we are going to be left with is net proceeds. What we are going to left with is net proceeds. Are we clear with this? Yes. Now, when I talk about the most advantageous market, when I talk about the most advantageous market, it is not the one on the what you can say. It is not the one that is there on the uh, second. Yeah, it is not the one, the basic price that is there on the left hand side, 1,500. But when I talk about this, it is going to be the net profit of net proceeds of 500 and 650 that decide what is going to be your maximized net proceeds. So in this case, the maximized net proceeds could be only 650. It could be only 650. And because it is higher than the local market, we can say that the most advantageous market for these mangoes is the export market. Is the export market. Are we clear with this? Yes. When I say transportation cost, I specifically mean any cost that alters the characteristic of the asset, alters the characteristic of the asset. Sir, what do you mean by characteristic? It could be location of the asset, yes or no. So transportation is moving the asset from one location to another. So you are changing the features of the asset, and that is why it goes and sits under the heading of transportation cost. Okay, transportation cost. Are we clear with this? Yeah. Are we clear with this? Anybody has any doubts? So when I talk about most advantageous market, it is that market which maximizes the inputs, which maximizes the net proceeds, sorry, which maximizes the net proceeds. And what is net proceeds? It is the selling price minus the transportation cost minus the remaining. Yeah, done. All right. So transportation cost examples are also given. So now, when I talk about transaction cost, it is like brokerage, commission, etc., etc. So now, when I talk about Yes, 500 and 650. So that takes care of net proceeds. Now, when I talk about fair value, tell me one thing. Do I have to consider entity specific transactions, or do I only consider those transactions that alter the characteristic of the asset? What do you guys think? It could be freight also, Namrata. It could be freight also. Okay. It's not just limited to freight. For example, you have an unconstructed under construction inventory. Okay. An under construction fixed asset. Now, if I have to calculate the fair value of that, I will estimate the completion, how much I will incur, what will be the cost after that, and then determine the what you can say, and then determine our uh, transport cost, okay, and then take it as our transportation cost. So therefore, this particular activity of completing the job which you are estimating, it is altering my product. It is altering my product. I have a half constructed building. I am yet to construct this part, but when I do the fair valuation of the asset, I will do it for all the items minus what you will say is this part is altering the feature of the asset. This part is altering the feature of the asset. How, sir? Well, it is going to come up with an additional construction, an additional floor, an additional slab, and therefore, you are going to change the nature of the asset. When I talk about freight, the goods are in your factory, in your godown, in your warehouse. From your factory, the goods are getting shifted to the marketplace. So therefore, the characteristic of the asset was situated in the godown. Now that characteristic changes and it will be made available at the marketplace. So the characteristics of the asset could mean the location where the asset is actually situated. So when I say transportation cost, you cannot limit it to only freight. It could be any other transportation cost. It could be any other transportation cost. Are we clear with this? Yes. Freight alters the location of the asset. Freight alters the location of the asset. And because it alters the location of the asset, it means that its feature has altered, its characteristic has altered, and that is how it is going to be treated. Are we clear with this? Yes, are we clear? Anybody has any doubts regarding this? Anybody has any doubts regarding this? Yeah. It is clear. So the transportation cost, don't take it as only the freight. It could mean any cost. It could mean cost of completion of an asset, cost incurred to make it saleable. All these items is going to be included. But what will not be included in the fair value? Okay, I'll come to the fair value later. When I talk about transaction cost, it means cost that is incurred for the purposes of ensuring the transaction goes through. It could be brokerage, it could be commission, it could be certain specific sales expenses, etc., etc. So that gives us our net profit, that our net proceeds. Where the net proceeds are high, that market is going to be your most advantageous market, MAM. Okay. So the most advantageous market is one of the, what you can say, most advantageous market is one of the key items for determining the fair value, So fair value, how do I compute? Well, fair value is nothing but price minus transportation cost. Price minus the transportation cost. So this is how it is going to be. This is how it is going to be. This is the final definition of your fair value. I will not deduct transaction cost because that is not asset specific. That is your what you can say. That is not your asset specific cost. That is more as a transaction related cost, and hence it will not be included here. It will not be included in this part. Are we clear with this? Yes. सबको सब कुछ समझ में आ गया? Yes. Okay, so net proceeds is equal to available price minus transportation cost minus transactional cost. Minus transactional cost. Is it okay? Yes, so go through this as for homework. Okay, so here I have discussed key aspects: price, what is fair value, what is net realizable value. Okay, I'll be taking this. Okay, yeah. Done. Namrata, is your doubt sorted out? Any doubts, Namrata? Yes. Okay. All right. Fine. So therefore, in our example, fair value is going to be how much? Let us have a look. In our example, what is the most advantageous market? Such 650. So therefore, what will be my fair value? My fair value will be export market will be our pricing. Export market will be our basis for determining the fair value because export market is our most advantageous market. Achha, why do we have most advantageous market? Well, the standard believes that you are a rationally thinking sound businessman and therefore you are going to do the sales in the most advantageous market itself. And that is why it has said that the values appearing in the most, what you can say, the values appearing in the most appropriate market alone will be the basis for determining the, what you can say, for determining the fair value. Okay, so that is what is there so far. So to summarize today's discussion, we started off with what is the meaning of fair value, why did this standard come in. Now coming to the definition of fair value, we saw that it is a price received to exist, a price received to, what you can say, price received to sell an asset or paid to transfer a liability. We have seen this. In a transaction between market participants, we have seen this. And in a transaction, price received in In a transaction between market participants, we saw who are the market participants, and in the appropriate market. So appropriate market we discussed were of two types, and in these two types we are having one is the principal market and the other is the most appropriate market. The other is the most appropriate market. Okay. So the principal market is going to be your what you can say first priority for the purposes of determining the fair value. If the principal market does not exist, you will look at the most advantageous market. Okay. And in the most advantageous market, you will then look at it is the market which maximizes the net proceeds. So in our example that we did, the most advantageous market is the export market. And therefore, the fair value, I had gone wrong. I had taken the local market figures. The fair value will be the value in the export market. So that comes to rupees 800. That comes to rupees 800. Okay. It was my mistake. I have taken the export market right now. So therefore, we have we would be taking 800 as the fair value. This is based on the presumption that the entity is a prudent, rationally sound entity which will sell its product in that market where the proceeds are going to get maximized. Proceeds means available price minus the transportation cost minus the transaction cost. Transaction cost is basically brokerage, commission, expenses incurred specifically to the sale transaction, etc. Your transaction cost cannot be forming a part of the fair value calculation because it is a transaction related cost and not an asset related cost. But the transport cost will be deducted in arriving at the fair value because that is an asset specific cost in the sense that it alters the feature of the asset. When I say transport cost, I don't only mean freight, although it does include freight, because freight alters the feature of the asset in the form of the location of the asset, which is an important feature of the asset. It could also include costs like cost to complete an asset, additional cost incurred to make the item saleable. So all of these would be included in that transportation cost ambit, and they would be deducted from the available price to arrive at the fair value. So with this, we conclude our session today. The fair value computational part, we have discussed the principles today. Tomorrow, we will just be quickly summarizing again what we have done, and then we will go further to liabilities and equity and close the session tomorrow. Okay. So with this, we conclude. I will see that this presentation is uploaded. It should have been uploaded. I will check with the institute. Okay. Please revise what we have done. Please go through. Most of it is you can just have a look at the questions which I have told you to do. Please ensure that you do these questions. This is taken from the latest study material. Okay. So one is your example on page 4.9. And then you have examples 2, 3, 5, 6, example 9, example 7, example 8, example 10. Up till example 10, you should be in a position to do. And even question number 1. Okay, you should be able to try out this question. Okay, you don't have this, but you should be in a position to try out the question number 1 of test your knowledge. Okay. If you are unable to solve, we will be doing it in the next class. For considering most advantageous market, we consider available price, transportation, transaction cost. Yes. Then we select that market where it is maximum. And once we select that market, in our case, it is the export market. There we will consider only the sale price and the transportation cost to arrive at the fair value. That is how it is numbered up. Okay. So that takes care of question. Please try question 1. You should be in a position to do that. Okay. Then we move on to certain small topics tomorrow to close the discussion. Okay. So thank you everyone, and stay safe. See you guys tomorrow with further clarity, a further discussion on this standard. We should be in a comfortable position to complete this tomorrow. Okay. So thank you everyone and see you. Okay. All right. Sir, session concluded. Okay. Thank you. Kalman. Okay. Yeah.